Now, we calculate all the costs of capital, like capital of all costs. There are three different types of the securities, financing securities. The first one is equity, the second one is debt, and third one is preferred stock. Now, how to calculate overall average of the cost of capital? So use this individual cost of capital, we can compute the average cost of capital by giving weight in each security, each financing way, each cost, each capital. And this is called the weighted average cost of capital. Usually we call it WACC. So weighted average cost of capital is commonly called WACC. And this WACC is the overall average firm's cost of capital. So this average equals to the required return on the firm's asset, basically based on the market perception of the risk of this company. And this weight can be calculated by how much of each type of financing, debt, equity, and preferred stock is used. So how to determine the weight for WACC? Now each weight is the percentage of the firm that will be financed each component. And we have three components again, the equity and the debt and preferred stock. And if you are equally weighted in each, then it's kind of 1/3 in each. That will be the weight. So weight always changing, right? Weight always changing. Now we always use target weight, which is the weight that the company should target. Because in fact, your current weight is always changing. So the company usually has the target weight of each component. If it is not available, then we can use the market value. So there's a notation for this calculation. So E is the market value of the equity. Is basically number of outstanding shares times price per share, stock price. D is the market value of the debt, and then number of outstanding bonds times bond price. And if we only have 2, not 3, so we don't have the preferred stock, then the market value of the firm is simply debt plus equity. And each weight is simply the equity divided by value, the market value, and debt divided by the market value. Then here we have 3 factors here. In fact, let's define one more, the P, which is the market value of preferred stock. Okay, so let's define it. And then P divided B is the percent finance with preferred stock. Okay. Then the WACC, weighted average cost of capital, equals to, this is the weight on equity. So equity value divided by market value of the firm times cost of equity, plus this is the weight of preferred stock. So preferred stock market value divided by market value of the firm times cost of preferred stock. And now third term is a little different. So this is the weight of debt divided by market value of the firm times, this is after before tax cost of debt times 1 minus C. So this before tax cost of debt times 1 minus T, tax rate is actually after tax cost of debt. So the third factor is a little different. So this is the example. So our stock price is $50. There are 3 million shares, number of shares outstanding. and then $25 million preferred stock, and $75 million debt, and we have TC equals to 40%. So you can calculate, this is E, this is P, this is D, right? And the equity value is $50 times 3 million, which is number of shares outstanding for common stock, and it's going to be $150 million. And the preferred stock value, that value is given, $25.75. So our total value, market value of the firm is $150 million plus $25 million plus $75 million, which is $250 million. So that's the value of the firm. So in fact, the weight in each, so weight of equity is $150 million, value of weight, equity, divided by values, market value of the firm, $250, so 60%. Preferred stock P, $25 million, divided by V, $250 million, 10%. And weight of D, the debt, $75 million D, and $250 million again, V, 30%. So this company financed 60% therefore, 60% through equity, 10% through preferred stock, and 30% through debt. That's what it means. So we have 30%, 10%, 60% weight, and now if our cost of debt before tax debt is 10%, cost of preferred stock is 9%, and cost of common equity is 14%, we can calculate WACC using the formula we have. So first factor is equity factor. So weight of equity 60% times cost of equity 14%. Second factor is the preferred stock factor, 10% preferred stock weight times 9% preferred stock cost. And then third factor is the after tax cost of debt, 30% weight of debt, 10% before tax debt, the cost of debt, and then 1 minus tax rate. If you compute this, and 11.1% is weighted average cost of capital. So that's how to compute the weighted average cost of capital, WACC. So what factors may influence a company's WACC? There's a number of factors, obviously, but especially the market condition, very important, especially interest rate, tax rate, and the market risk premium. And these factors, interest rate, obviously directly related to the cost of debt. Tax rate, obviously cost of debt, because we can calculate the after-tax cost of debt. And the market risk premium is used when we calculate the cost of equity in capital model. And dividend policy is important. Capital structure is also important. Capital structure is the proportion of each components of the financings. So it determines each weight. Dividend policy now is related to the cost of equity too. Now finally, the firm's investment policy, which is related to risk. So if the firm prefers higher risk project, then generally speaking, sorry, this is a little delayed because of the technical error. So let's go back to the things that we are on. All right, here. So the firm's investment policy, the firms with riskier project, generally higher WACC, less risky, and lower WACC. So that's the factors that affect to the company's WACC. Now, the problem is each project has different risk. Now, how to determine each project WACC, not just for average WACC. So this WACC just reflects average project, but each project has different level of the risk. We need to adjust it. So this is called the risk-adjusted WACC. So for example, this is the example of that. So assuming that our WACC is 15% and there are 3 projects, and the ABC has different IRLs, and we accept the project if IRL is greater than R, which is WACC, right? Because that's the discount rate we use. Now A17, B18, C12, so we accept A and B and reject 12 from the decision rule. The problem is when we use this WACC as a discount rate, required returns, it means that the risk level for these three projects are kind of very close to the average risk level of the firm. Now, if it is not true, then see what happens. Now, suppose A is the riskiest project and the C is the least risky project, and B is the average risk. Then we adjust WACC, the required return, so let's give 5% point more for the riskier one. So new required return 20, and the average is just WACC 15, and then less risk, let's subtract the 5% point to lower the required return to 10. So suppose this is R, and we accept the project if IRL is greater than R. Now see IRLs here. Now this is original decision, but decision changes because now the first one is too risky. We reject the project because IRL is lower than the risk-adjusted WACC. Second one is accept, and third one is actually again changing because this is not very risky project. So we only require 10% after risk-adjusted, and the IRL is 12, so accept. So if you adjust the WACC, then we may have different decision. So now this is the graphical representations. Now the red line is just WACC. So using WACC. Now if you use the risk-adjusted WACC, then the acceptance region is here and the rejection rate is there. It's changing. So how to determine this risk? That's very hard. There are two approaches. And first approach is called a pure play approach. Now, suppose you have certain divisions, and find one or more companies that specialize in the product or service being considered. So we try to find several companies that has specialties only for that product. Compute the beta of each company and take the average, and you use basically this beta when you calculate the cost of equity for CAPM and calculate the new WACC. So that's called a pure play approach. So you find pure players. The problem is you are not pure players, maybe. That's why we try to risk just a risk. There are not many pure players. And pure players probably are not the big or competitors of yours. Maybe just startup company that has much higher risk than you. So it's really hard to find pure play competitors. So next approach is subjective approach. Subjective approach is now consider the firm's project risk relative to the firm's overall. So now we have WACC. So it's kind of the same approach that we did previously, previous slide. If the project is riskier than the firm, now let's see some kinds of the higher rate than WACC, and it is less risky than just lower than WACC. How low, how high? It really depends on you. Depends on the history. So usually the company has a statistical analysis to determine this type of the risk-adjusted WACC. So this is one case. Like they categorize the risk level into 5, very low to very high. Then there's some margins here, right? And this is new discount rate. So this is the subjective approach. So this is end of the chapter 12.